What the hell is he doing? I don't know. You gotta shoot. Aim high. I don't want to hit the ground. Well, we mustn't keep our public waiting, huh? It's showtime, dude. Right on me, Larry, in 3, 2.
Live from sunny Southern California, it's the Real Life Trading Full Year in the Making. Classes you've all been waiting for. Real Life Trading's totally free. Futures Trading Education. Tonight is Class 8 on market internals and trading the indexes and the importance of knowing when your economic reports are. In this class, we're going to talk about the sector components, the personality of each index, the market internal indicators, how to interpret them, and the potentially market-moving news events and where to find the schedule. My name's Caryn. I'm here to help each of you reach the next level in your trading, not just in futures, but in all the markets you trade. I can't believe it's Class 8. We're almost done with everything. But before we get started, let's interrupt this program to bring you this word from the legal department. Trading is risky. Never risk money you can't afford to never see again. No one clicks your mouse but you, so click responsibly with full knowledge and personal accountability, because each decision to click that mouse is yours and yours alone. We got a ton of information to cover tonight, so we're going to skip the review and jump right in. Okay. There's 2 states of the market, balance or range bound. Right now, I'm talking about how to trade a range bound day. I think you guys are pretty good with this. But first things first, don't forget to look at the day before. What happened yesterday? Was it a breakout trend day or was it a range bound day? If the previous day was a bullish breakout day, then I would have a bias to buy the value area low with the hope of getting late day range extension. If the previous day was a bearish trend day, what do you think my bias would be? If the previous day was bearish, would I be looking to get a bearish entry or a bullish entry? Yes, bearish entry. And if I was looking for a bearish entry, what would be the ideal point? Would it be, let's see if I can get this pen to work. Yes. Top of the IB, value area high. Very good, you guys. Yes, absolutely. Do I want to get bearish down here? Even if the previous day was bearish? Down here below the value area low? No, absolutely not. Not unless we're seeing some major momentum. Okay, so here's a question for you guys. Provided there is no sign of a catalyst to turn the day into a breakout trend day, and by catalyst, I mean, scheduled major economic report, and it is not a notable narrow range bar day. So if there's no major economic reports on this trading day schedule, what is the first hint that the market could have a range-bound day? I'm not going to agree with weak internals. A small IB could be. Okay, you're close. Same IB as yesterday. Yeah, that would, Tim, I think you're the closest so far. But yes, what I was going for was, I've got to change this back. Okay, it should work now. Large IB. Large IB gives you a big range, and it's most likely to stay within that big range. Medium IBs can be good too. You just got to watch out for the possibility of range extension later in the day. The reason I don't like a small IB as making it likely that you will have a range-bound day is small IBs can also be the birth of new trend. So I do not want to count on a small IB to create a range-bound day. Now, that's interesting you said that, Java, because a mature volume profile is actually showing you the potential for breakout. An immature volume profile would signify the potential for a range bound day. So trading a range bound day is fairly simple, provided there's a decent sized range and you can get your risk to reward. Look for short trade signals from, and I've got to grab the pen again. You'd think somebody would just like make it work for you. All right, so you look for shorts up here. Put your stop a couple points above. Look for longs down here. Put your stop a couple points below. Maybe 2.5 if it's a volatile day. And and then your target is the other side. If you're long from here, this is your target. If you're short from here, this is your target. Now, some people will take trades from here in the middle and will use this as a target. I'm not a fan of that. I think, it hits the POC. It can go this way. It could go that way. And then you're limiting your reward potential too. So really try not to buy or sell inside the value area. We've talked about this. The real edge is to buy below value and to sell above value. And if that confuses you at all, I think we had a whole class on that. In fact, it was the long one. I think it was class 5. Anyway, now if it's a huge range and the risk to reward is still good, it is okay to target the point of control or the VWAP as sort of a mean reversion kind of trade. Just keep in mind that if you're trading the profile of the developing day, the point of control can move on you. After IB is set, which is more important, IB or value area? They are equally important, especially in my mind, the IB, because once price starts to move outside of the IB, that's the potential for new trend. Now, if the value area ends or begins right there, that's equally important too, because you've got the value area low. It could be support or it could break. It's all interconnected. It's a matter of market structure, and we'll get into that a little bit more. Okay, so range bound trading. I think we got everybody's good on that, right? So I found this flowchart online somewhere, but based on what we've talked about, I'm hoping this kind of makes some sense about how the market moves and the KRA decision points, KRA being key reference areas. And you can see that the, I still have the TPO and volume profile on this chart, right? This would be, come on, pen. This would be the initial balance, right? We're looking at a range bound day. We sell here. We buy here. We'll just put it that way. And then here's the point of control. And this is going to be a pausing point and actually a decision point on each move, either down. It'll probably hesitate here before it keeps going down, or it might do this and bounce up. But it comes back up to the high. The potential is back again to do this. It's already touched this once. It may hold as a support, or it might keep going down to the value area low. So this kind of gives you a very clear idea, I think, of the decision points and how the price will move between these three points on your profile. So, and in the end, because we're talking about a range-bound day, basically the shape of this profile is going to be, well, it won't be that, but I'm sure you get the idea. It's going to be that bell-shaped curve or something pretty close to it. Maybe it's on a lollipop. Maybe it's got a little handle on top, but you're going to get that bell shape. That's the definition of a range-bound day. All right. So when balance breaks, we want to look for opportunity at the nearest key reference area. In this case, the next key reference area to the downside is this untested POC. at 92.50. And I would expect, looking at this chart, that there would be another down move in the next couple days. And that TPO point of control or high volume node would probably be a reversal point, and that the reversal would continue at least to the bottom of the value area. This one here. Come on, pen. Not that one. This one right here. Okay, so let's take a look. And for the record, I actually put this together before this happened. And sure enough, that's exactly where price broke to the next time it moved downward. It tested this naked point of control and bounced. Sorry, this pen thing drives me crazy. Okay, so why didn't it stop of one of these two red X's over here on the left? Anybody want to make a stab at that? Okay, we'll cut to the chase. It's already been tagged out. We've traded. Oh, God, this is crazy, this back and forth. It's already been tagged out. We broke these two lines with this move down here. So they're voided. They're no longer support. They're no longer resistance. And that's that for those. So if price continues upward from this purple circle, boy, there's a lot of clicking around with it. Oh boy, I didn't quite think this through. So if price continues upward, like it's already doing from here, what's the next level of resistance? Yes, Frederick Atwater, absolutely. It just tested that high volume node. Liral, yes, very good, you guys. So if price, ooh. So what's the next level of resistance above? Liral, you nailed it. Yes, 24.99.75, which is the value area low. So much clicking just to write stuff in. Here we go. So that level is now broken because we've traded both above and below it, right? No longer support or resistance. This is our next resistance. I put it at a 2,500. I just sort of estimated it. Pardon me. Sorry, guys. I still have a little gunk. So if price continued upward from the developing value area low, what is the next key reference area where we might expect price to at least pause or maybe even reverse? Okay, and why did you guys pick that area? What is that level called? Very good. The point of control at 2503.25. Now keep in mind that this is the developing value area we're looking at. So that point of control can move throughout the day. It might go higher, it might go lower. So it's kind of a moving target, which is kind of why I'm not a fan of using them intraday unless they're from another day. I don't like the developing one so much. It's too wiggly. Okay, so, but it's a valid point of resistance. It has yet to be broken through from below. So if price does make it through and continues higher from the developing point of control, what's the next resistance level based on key reference areas? Exactly, Mark. Very good. Value area high. Yes, Catherine. Good job, you guys. Okay. So let's see. I don't have the pen. So there it is. You nailed it. Awesome, you guys. Now, this might be a little trickier, especially since there's doesn't look like we've ever traded above this level. If price gets above this third resistance, first of all, it will likely come back and retest it. And if that level holds as support, name some ways we could guesstimate a target. And I'm going to give you a little time to answer this one. Yes, fibs, trend lines, good. Well, but I think we might be above the previous day's high by then. IB. Oh, Susan Dowis. I hope that's how to say your last name. You just nailed it. Measure the move. Exactly. That's what I personally would do. My guess is the fib lines would probably come out to about the same place. But the measured move, target. Now, finding the exact point to measure from, just like putting on a fib line, is always kind of a personal decision. Some people measure from the swing high to swing low. Some measure from the extremes. There's no right or wrong answer, but I like to, I prefer to be sure that I get a fill. So I tend to be a little more conservative and not quite so gung-ho. I'll go from the swing high to the swing low rather than the extremes. So on this chart, I would say the swing high is, I don't know, we'll call it 2505, and the swing low is 92. So that's 13 points. On above 2505, which would come out to 2518. So if the trade, because remember, where did I get in? I got in here. You see my arrow, I hope. This is where I got in. I was expecting price to bounce at this level, and I had an order sitting there waiting for it. So my stop is like at 24.90, 24.89.50, somewhere around there. So just to get here, I had the risk to reward of like 7.5 points. So I had the 3-to-1 from the start. The maximum potential on this 2-point stop would be 26 points. Now, frankly, that's a lot to ask from a market that just took a giant dip without any news. We'll get a little bit later in this class, we'll get into market internals, which will help you make better trade management decisions and determine if that measured move target is really a reasonable place to aim for, or if you'd be better off maybe getting out at the developing value area low or the DPOC or the value area high. Anyway, you guys, great job. We've planned the heck out of the upside KRA trade. Now let's take a look at what might happen if it rolls over to the downside. Okay, so now we're going to examine what would happen if price is rejected at the value area low or any of these other potential levels of resistance. So let's see. If price turned down, if price got rejected at the value area low of 2,500, what is the nearest KRA to the downside that we would expect? That's funny, Freddie. We might expect price to bounce a little or pause at least. Literal. Well done. Yes. 87.25. Sorry. Because we have this price extension line. And actually, this isn't entirely fair. But let's see. And then we've also got this high volume node down here at 85.25 and another one. Well, this is a low volume node. Then I drew these in because, even specialized charting software, you can only program in so much or you end up with too much on your screen. So I just sort of drew these in myself. Let's see what the next chart will bring. Okay, I did have them there. So those are the three places that somewhere between 87.25 and 83.50, I would expect there to be a pause, maybe even a bounce. So let's see what happened. Ta-da, there you have it, right into that zone and bounced. Now, using the same process we used before, when it bounced, what was the first point? Closest place of KRA resistance. Come on, you guys had it before. Yes, the value area low. Exactly. Very good. All right. So, and after that, if it kept going up, what would be the next KRA after the value area low? Exactly. Point of control. Very good, you guys. And after that, if it kept going higher, well, yes, value area high. And if it broke through the value area high, yes, Catherine, you got it. If it breaks through the value area high, comes back, retests, and holds, what are we looking for after that? Now, we do have a little bit of stuff above now, but pretend there wasn't. Yeah, if it went up above the value area high, yes, a measured move or the next closest value area low that hasn't been demolished. Now, oops, not the laser. I want the pen. La, la, la. There we go. Okay. So this value area low, is that support or resistance? Is it? Have we broken it to the downside? Have we broken through it from above? Yes. Have we broken through it from below? Yes. This doesn't count. What about this POC here? Is that one support or resistance, or is it dead? Exactly. Invalid. It's dead. So what's the next one? Has this one been broken through from above and below? I don't know. It's hard to tell. It may have touched there. But yeah, I would say that would be the next open point. And my guess is it will. Well, we know it's gotten there. What are we trading at now? 25.50 or something? Almost 25.60. Okay, so we had a little problem with this last time. So I just kind of wanted, Catherine, this is in Sierra charts, and this is the weekly, just because there's less noise, it's easier to see what's going on. At the end of the class, I'll show you guys again how to do it. Okay, because last time we had a little trouble with this. Okay, now here's a similar price flow chart for a trending market that shows the same decision points we just talked about. Is everyone feeling a little more comfortable with this price discovery process and what the key reference areas are and when they matter and when they're dead? And I'm hoping to get more than one yes. Okay. Well, two. I'll take two. Okay, great. I'm dying to move forward and show you what I like to use to help determine if a trade I'm in is likely to succeed, or if I should jump out early, or maybe try to hang on for more. And it's always in conjunction with these key reference areas we just talked about. I'm totally not all in on the dead spots. Catherine, let's talk after class. Okay. All right. Let's get into some new stuff. So, market breadth. We've talked about two states of the market and different factors that can cause imbalance or trend or directional move, whatever you want to call it. As day traders, that's what we want. We want the market to move. That's how we make money. If the market isn't moving, making money is pretty dang tough. So I want to show you some of the tools that are available that can help you evaluate breakouts in the moment and to really decide for yourself if it's a trend that's beginning or if it's just a fake out. They're called market internals, and they measure the market's breadth. I don't even know how to say that. Breadth and momentum, which is essentially how wide or narrow the range of the participating stocks is in the current up or down move. Now, this matters because all of these indexes that we trade are weighted by market capitalization. and the Dow is price weighted. Now, capitalization and price weighted indices are controlled and driven by their largest components. So the stocks that make up 10% of the index can account for 35 to 45% of the index's movement. Apple can move the markets all by itself, except not the Russell. But if Apple is the only stock that's pulling the indexes up, what happens when Apple loses steam and rolls over? Is the market going to keep going up? Or is it going to, right, the market's going to follow. It's going to fall to pieces. So that's why the breadth matters. The more equities participating in the move, the more powerful and prolonged the directional move will be. I don't know. Was that like Yoda talk? Did it make sense? I hope it did. Okay, so looking at charts of market breadth sort of neutralizes that price effect of large caps like Google, Apple, Goldman Sachs, Microsoft. These are the ones that can really kind of move the indexes all by themselves, or as they like to say, float all the boats. And the market breadth lets us make an honest kind of an objective assessment of the overall market sentiment and strength. If breadth is narrow, rising on just a few big names, then we can look to close longs and perhaps, take shorts when those big names start to decline. Market internals are not going to reveal information about anything other than the indexes. Now, it's not going to affect lean hogs or soybeans or crude oil, gold, silver. They're only useful for trading the index futures or the index ETFs like SPY, Q, IWM. And because, this is like the part I hate, because the market internals are based on the number of stocks doing this versus the number of stocks doing that, market internals data is only available when those stocks are trading. In other words, it's only available during the regular trading session hours. There are no internals to look at in the overnight. There's a lot of different market internals. I've tried a lot of them, and some work sometimes, some work other times, sometimes none of them work. But these are the ones that I kind of keep coming back to, and I use to help stay alert for like potential reversals, breakouts, fake outs, which means la 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 la, we get to meet one more tick. So that's right, there's another tick, but this is the last one. The tick offers a sort of moment-by-moment view of market optimism and pessimism and the strength of the sentiment. Tick plots the difference between the number of stocks that just traded up a second ago and the number of stocks that just traded down a second ago. If the tick is holding above zero, that tends to be a more optimistic kind of a day than if the tick is holding below zero. Generally, I look for tick to sustain on one side or the other of the zero line, or for it to be trending in one direction. Tick can also be helpful in spotting the shift in sentiment, and often it'll give you a hint which direction a balancing pattern is likely to break. If the market is chopping, churning, constantly forming head and shoulder patterns, the tick is not going to help you. In fact, when the market's behaving that way, usually means the tick's behaving that way, and there really isn't much to do in the indexes. There's not going to be much worth trading. So I guess it kind of gives you a hint when not to trade the indexes. What do you know? Now, I'm probably going to say this a lot tonight, but a word of caution about the tick and frankly, all of the market internal indicators. None of these are giving you trade signals. What you see in the indicators is not actionable until price proves it's true. I know there's a lot of folks out there who love to fade tick extremes. If tick gets over 800 or below 800, they have like a trade that they automatically do. But the fact of the matter is, under certain market conditions, rarely, but it can happen, the tick can stay above 800 all dang day, or it can stay below 800 all dang day. It's just it's a bounded indicator. It can only go so far. What does matter is how tick moves relative to its range in the context of that day. If the tick has been in a meaningful, a tick extreme is more meaningful if the tick has been in a narrow range all day, and if the indexes themselves have been in a narrow range market environment. Then an extreme tick is meaningful. It means that suddenly there's fresh interest in one direction or another. Now let's see. That's enough about tick for the moment. Trin. I don't know. Is anyone familiar with the ARMS index? You guys ever use this one? Rarely. Okay. Well, it's named after Richard Arms. That's the guy who developed it. And it uses like some complicated relationship between the trading volume of the advancing stocks and the trading volume of the declining stocks to plot potentially overbought or oversold market conditions. Most of the time, it's useless. But I do like it intraday when it hits extremes. Oh, that's an interesting point. I hadn't thought perhaps the ETFs had anything to do with it, but it can be a little tricky because it's inverse to the indexes. So it plots the opposite of what you would intuit from it. When trin moves upward, the market theoretically should move down. If trin moves down, the theory is the market should go up. But it's all about where it is. If the trin is above 1.5 or 2, that's kind of a bearish sign. And that's really, I set the alert for if the trin gets above 2, let me know because I want to close my longs at least. And supposedly it's bullish when the value drops below 1. But my experience says don't even bother with it unless it's got a reading under 0.5 or over 1.8 or 2. And it doesn't last forever, like anything, just till, the trend returns to that neutral zone. What else we got? And the VIX. Pretty sure everybody's heard of this one. It measures the short-term 30-day market volatility based on the price of S&P selected S&P 500 index SPX calls and puts. Biggest problem with the VIX is that it's become so popular. There's a lot of imitators. It can be hard to find the actual indicator itself. And used to be VIX levels above 30 signified high volatility and below 20 indicated low volatility. Hasn't been that way for a while, as far as I can tell. It seems like lately, at least this year, anything above 12 is high volatility and below 10 is low. Let's see. Basically, moves in the VIX depend mostly on market reactions. It only spikes when there's sudden buying of puts. And unless people are buying puts, the VIX isn't going to move. Okay, let's move on. Okay, so this is the tick. I like to think of the tick as an early warning system for intraday market turns, like when a new trend may be beginning or a current trend may be coming to an end. Most of the time, price and the tick will be moving together in the same direction, positively correlated. But when price is approaching a key reference area, like say this was the value area low, and price is approaching it, and here's the tick, it's already bounced off that area. So that would be a hint to me that the value area low is probably going to hold. My guess is actually it's probably more around here. So I could buy anywhere below, put a stop a couple points away, and hold it until the tick told me to get out. Or priced it, or it hit the point of control, all of those key reference areas. So when tick starts heading the opposite direction from an index, it's diverging in price. And it usually implies there's going to be at least a pause at that key reference area. And if the tick's move is dramatic, possibly even a reversal, which is probably what came next here. I'm guessing this went right back to the value area low. I like to use two tick charts, one set for 2 minutes and the other set for 5 minutes. And that way I don't get deceived by the occasional flash spike to the upside or the downside. Next. Okay, trin. Inverse relationship with price. Measures, yeah, you've heard all this. Anyway, if the trin is rising, it indicates selling is coming into the marketplace. So if trin is doing this, that's selling. This, believe it or not, represents buying of the index. Or excuse me, not here. I'm trying it on the S&P. Here. This is buying. You know what? Let me just erase all of this because that's all quite confusing. And sorry, guys. Okay, so here's the Dow. This is the Dow futures. Here's the trend down here. Duh. Okay, so when the trend is decreasing, this represents buying in the index. When trend is increasing, right, moving up, that's when they're selling in the index. And again, it's about the extremes. I would forget these numbers. I would say bearish is like 1.8 to 2. You can pretty much count on a reversal up around those levels. And bullish, I mean, I've seen it get as low as 0.5. And anywhere between these two, just ignore it. It's not going to help you in any way. Okay, moving on. Okay, VIX. You guys know this stuff. Frankly, I think it's a mess. The one thing you never want to do, at least not in a bull market, is buy VIX stock or any of its, or the double VIX, because the VIX is a constantly decreasing instrument. And when it gets to a certain point, they do a reverse split, make it look like it's gone up, even though it hasn't. And you just, over time, long run, VIX is not something you want to like buy and hold. It's not good protection. The key to trading the VIX well is to jump into it like right before a move is expected. Yes, short term. Thank you, Jeremy. Okay, next. Okay, now these are probably familiar to a lot of you, but maybe not everybody. ADD, the advanced decline line, and the VOLD, it's like the volume differential or something like that, are pretty easy to interpret. They're read the same way. If they're both rising, the market should be rising. If they're both falling and the market is rising, that's a hint something's happening, that the trend may not continue, but it is not a trigger. If the market is up and the advanced decline line is trending downward, it's usually a sign that the market is losing steam. It's losing breadth. It's losing momentum, and it might be getting ready to change direction. But it's a warning sign. It's not a trigger. And something I've noticed about both of these is that they trend and make patterns just like, Mark will get there, just like all of these, all of your other charts. You know, a head and shoulders on the advanced decline line is a head and shoulders. An inverse head and shoulders, a wedge is a wedge. A rising trend is a rising trend. And if it breaks down or breaks upward for from that trend, that's a valid I hesitate to call it a signal, but that's as important as if a stock or an index that you're trading breaks its trend or completes a pattern or fails to complete, rejects the pattern. Now, but again, not a trigger. It's a warning sign. ADD line, it can be awesome. Sometimes it'll happen right away. Sometimes it'll take 10 minutes or it'll take a couple days for divergence to play out. So don't jump on it just because of that. Wait for price and the key reference areas to say, okay, this is the place. Price action, market structure in context of the week, the day before, and the moment. It's always the primary means of assessing the state of the market. Price action, market structure. All these other things are like offering you hints. Okay. Never enter a trade just because an indicator told you to. In fact, no, that can't be right. Let's move forward. Yeah, I knew. Okay. I'm excited to get to this one. The CBOE skew is its own special kind of animal. Again, it's not a signal. It's not a trigger. It's like that. It's that yellow flashing light saying the road might be flooded or icy. It might not be, but it's warning you. Maybe it could. Now, the skew is only updated once a day. This is not an intraday indicator. So I look at it, at the end of the day, and I'll remind myself what it is again in the morning. Most of the time, there's nothing there, but every once in a while there is, like tonight. Tonight, the CBOE skew is over 150. That's pretty high. And to me, that is definitely a heads up warning that some manner of pullback is likely to come within the next day or so. Last time the skew got up this high, or even close to it, was back in March here. The skew was at 154.34 and the ES fell 50 points in 3 days. That's 50, with a total of 71 points from swing high to swing low. That's significant. Let's see. And, back here in August, we had a pretty high skew and the ES fell 50 points in 3 days. I guess that's kind of like the standard. And then maybe you get a bonus fall. 3 points and 50 points in 3 days. So, like I said, it doesn't mean you sell this second, but it's a heads up warning that some manner of pullback is probably in the works. You want to pick your place based on the key reference areas. And, have your stop loss. But when I saw this tonight, I got excited. I had to add slides to our chart. I had to change them out. Okay, that's all the internals that I care about. So let's talk a little bit about time of day, because that's something that I feel is important. It's one of the first things I do before I enter a trade is check out what time it is, because certain times of day are optimal for entries and exits, and other times of day, not so good. So, lots of people spend hours planning what to trade, and a lot of people forget about the importance of when. Even if you have a winning strategy on your side, the trade can still move against you if you place it too soon or too late. So aside from just market timing in general, understanding when to place a trade is just as important as what you were going to trade and where your entry and stops and targets are, because money flows in and out of the indexes with the open and close of each global market. So it's important to be aware of those openings and closings so you don't get sideswiped by a sudden influx of cash on an open or an exodus on the close. Now, this is not a hard and fast rule. Some days the market's waiting for economic data, or perhaps one of the markets is closed for a holiday, and it always gets thrown off a bit when there's that shift between daylight savings and standard time. So these times are all kind of ishy, if you know what I mean. Don't like take it to the minute, somewhere around this time, it's likely that this will be the condition of the market. These are the key times I look at the market structure, and if price is near a KRA, I keep an eye out for an opportunity. The morning open on each exchange, everyone's excited. This is when there's going to be a lot of orders filled that were placed with the brokers and the large institutions. And the opening bell will often see a big move in one direction or the other because of that sudden influx of trades. To me, that's not the time to be entering the markets. The morning bell is not a high probability trade, in my opinion. It's great if it works out in your favor, but to me, it's 50-50. You might be right, you might be wrong. And there's many days when price has a big move in one direction at the open, and then it just retraces that move for the rest of the day. So I like to wait a few bars till the dust settles, at least. Lunchtime, traders sometimes forget that they're actually trading with other people too, and that those people usually need to eat during the day. And you'll notice that there are times around noon when the market seems a little quieter. Well, it's not just noon here, it's noon in Europe, it's noon in Asia. People eat lunch all around the world. If you're considering a trade around noon, make sure you're trading an instrument that has enough liquidity, because you got to have someone to trade with. If you can't, you can get in pretty easy, but can you get out again? And then around the close, usually a similar flurry in the markets that was like the open. It can be just as unpredictable as the open, but sometimes there's great opportunity. If it's obvious that everybody and their brother is long into the close, you can pretty much expect that some of those people don't have the margin to carry into the overnight, and they have to close. So price will come down a little bit. And, there's people who like to scalp that. Personally, I have a larger account. I see that as an opportunity to get long for the next day. Anyway, so you might be thinking to yourself, okay, I don't place trades at the open. I don't place trades at lunch or the market close. When is the best time to place them? I have 3 sweet spots when I like to place my future trades. The first one, and not all of you are going to be into this time, from 3 to 4:30 a.m. Eastern time, is usually going to be a nice little sweet spot, especially if you're looking for a long entry. That tends to be kind of the low of the night. 10 a.m. to 11:30. These are all U.S. Eastern times. That tends to be usually, by 10 a.m., I can get a feel for what's going on. I don't always wait for the IB to form. Sometimes it's just obvious. It's hit the value area low and it's going to turn here. So why wait for that extra half hour? And again, between 2 p.m. Eastern New York time to around 3:30 p.m., there's usually maybe one more entry. But if I've had a great morning, I won't bother. Hey, you know what? If I've made my 3 or 4 or 6 or 10 R, I don't need to keep trading. Take the rest of the day off and enjoy life. But those 3 times seem to have a good balance between direction and liquidity. 3 to 4:30 a.m., 10 to 11:30 a.m., and again, somewhere between 2 and 3:30 in the afternoon, Eastern New York time. And everyone's going to find a time of day that works best for them. Sometimes you see that this I understand, this I can trade, and it's going to be different for everybody. But I would encourage you to make sure you're aware what time of day it is before you jump into a new trade. Let's see, the overnight, can have some great trades, but not always. If you are interested in the overnight, like I said, I strongly recommend the European Open, beginning with London and then Frankfurt an hour later. You can get some great opportunities there. In general, the Asian session tends to be a snooze unless there's like some major economic report due out of China or a Bank of Japan decision, something substantial, or, if something big happened in the US session, that can keep going into the overnight as the whatever it was gets contagious around the globe. Now, speaking of economic reports, It's about time we get into those a touch. Now, this is a little weird here. Hang on just a second. Okay. Nearly every week of the year, new information is scheduled for release that can potentially cause imbalance in the index futures. Politics aside, it's a global market. It's open for trade nearly 24 hours a day, 6 days of a week. And the economies of the world, let's face it, whatever your politics, it's all interconnected. Reports from Asia and Europe can affect what happens here. Each market reacts to the moves of the others. And for trade entries and trade protection, it's crucial to know the upcoming schedule of global economic reports. Now, some tend to have a greater impact than others. These are the major reports that tend to move the U.S. index futures, but reports from the Eurozone, especially Germany and the UK and China, and to a lesser extent, Japan, Canada, Australia, Russia. Sorry, you guys, no offense, but they could also have impact on short-term market direction. Every once in a while in the news cycle, smaller regions become, a primary focus. You may remember that a couple of years ago with Greece and Italy, Spain, sometimes it's India, Korea, Brazil. The first surprising report from a smaller economy that the first one that surprises tends to have the largest reaction. And then over time, it gets to be smaller and smaller and smaller. Old news, nobody cares anymore. So when it comes to economic reports, does it matter if the report's good or bad? No, it doesn't. Daniel, very good. Yeah. So what about what I think if it's about the news? Does that matter? Okay, we got some smarties in here. Well, then why even have the economic reports? What does matter about them? Yeah, but we don't have the Yes, it does do that. Why do we care about them? Right? We're obviously not trying to anticipate what the market's going to do. We're looking for it to, yes, it does create imbalance, Mark. That's probably the best answer so far. But okay, Frederick, I'm going to give it to you right there. What we really care about isn't the report itself. It's about how the market reacts to it, if it reacts to it, and the direction that it takes from there. Now, there's all kinds of scheduled world events that can influence the markets as well. There's binary events like yes-no events like elections, or leave the European Union referendums, or let's be our own independent nation kind of thing. And then, of course, there's the unscheduled events. And I saw a couple people mention them earlier. These things kind of come out of the blue, help us, nuclear tests, bad weather, natural disasters, civil unrest, data breaches, corporate collapses, the leader of your company getting all kinds of sexual harassment issues. Those are the unscheduled events that can come out of the blue. That's just another reason to just always wait for a good trade location, because it's much easier to honor a logical stop than an arbitrary stop based on risk amount. News-driven markets tend to be very reactive and jumpity. Dramatic swings, parabolic moves, straight up or straight down. Often that's when we get the V bottoms and the V tops. And then when the market gets into that news-driven state, you can use the key reference areas for your market structure, but give yourself a little more wiggle room. Don't hold to those 2 points. Maybe give yourself 3, because the potential for the move following whatever the initial reaction is, and then the reaction after that, and the reaction after that, has the potential to be a larger than normal reward. Do we agree there? Okay. So it's okay to have a slightly larger stop when we're expecting more volatility. In fact, it's better because we want to give it a little room to breathe, right? Okay, so there's a lot of great sites that pardon me, that do the global calendar. I like global. Like I said, the market is open 24/7. Some sites just focus on the US, and I think that's a terrible mistake, especially if you trade at night. And, it's just better to be aware of what's going on in the world. We're all here on the same planet. As far as I know, none of us are leaving anytime soon. What happens in Europe or Asia does affect price action in the US as much and sometimes more as we affect their markets. My favorite of these, frankly, is investing.com. They get all the big reports and most of the important speaker events. Every once in a while they miss something, but I like it for its simplicity. You can change the time zone to wherever you are so it reflects your current time, or you can change it to the exchange you're trading or any other time you want. And they have like this really straightforward visual rating system. One cow skull is, not a lot of volatility expected. I don't have a 3 cow skull, but 2 is you should be aware of this one. And when there's 3, it means you shouldn't trade until this report comes out. And they let you they have filters over here. You can filter by number of cow skulls or by country. They've got a lot of nice features built into their economic calendar. If you're not familiar with the website, take a look. It's worth exploring sometime. And if you don't like this one, you can find whatever you want. Our old friend Google rarely disappoints. So just find one that works for you, but please make sure that it's global events, not just the US or not just the country you're in. Scheduled economic releases are times to be alert because new information is often what drives the market out of balance and into imbalance or trend. It's what we want. The worst thing in the world is to get sideswiped by some report you didn't know was coming out. Economic reports offer us opportunity, just like earnings does. It's a good time to look for new trades and an important time to close profitable trades or at least tighten up the stops. We don't have to understand what the report is or what it means. Doesn't matter if the news is good or bad, because we never know how the market will react, right? But we do need to know. Okay, those are bulls. Thank you, Sir O. But we do need to know which indexes will be the most affected by the reports. So that in mind, let's just take a quick look. Oh, and we're running out of time. Let me speed things up. At the makeup of the indexes themselves. This is just like a quick little doohickey to help you visualize which indexes are probably affected most by which reports. Different reports affect certain sectors and don't affect others. So just as the makeup of the indexes have some sectors but not others, the reports will affect different indexes differently. Now, pardon me, most of the stocks in the Dow don't do much, but Apple and Goldman lately, because of their weights and volatility, can make the Dow move. In fact, Apple is a goodly chunk of every index except the Russell. So if Apple is tanking, don't expect much upside from the markets, except maybe the Russell. The financials make up close to 25% of the Dow and the Russell, but only 15% of the S&P and none of the NASDAQ. Well, what kind of financial reports do we get? FOMC, consumer price indexes. These are things that affect interest rates. Those affect the banks and the financials. Industrial production. The strength of industrial production affects the FOMC's decision of whether it's a good time or a bad time to raise rates or not raise rates. So financials matter, particularly on FOMC days and some of these other reports. And if you want to trade those reports, you're going to be better off focusing on the Dow and the Russell than the S&P. And you certainly don't want to be fussing with the NASDAQ at all, because unless everything suddenly tanks, it's not going to affect the NASDAQ. You know, at most, there might be a small sympathy play. But if the NASDAQ goes down, someone's going to figure out, oh, wait, there's no reason for that to go down. And that could be a great buying opportunity. Energy, oil, more than 10% of the Russell and the S&P, 9% of the Dow. If oil is falling out of bed, you think those indexes are going to be able to rally? Falling out of bed meaning, you know, tanking, going down, 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 down. No, they're not going to be it. They're not going to be able to. We'll get to correlation next class, guys. They're not going to be able to rally if 10% of their market cap is going down. You know, you'd be lucky if they just hold steady. And the NASDAQ, I mean, everyone thinks the NASDAQ is technology. And it is, you know, over half of it is. But, you know, it's also another 15% of it here is healthcare. How many of you knew there was that much healthcare in the NASDAQ? 15%. I mean, that's a goodly chunk. And another Another 19% is consumer discretionary. What is that? 34%. So those could have an influence. If the consumer confidence numbers could affect the NASDAQ, the retail sales could affect the NASDAQ. News on Obamacare, repeal and replace, or, you know, funds being withdrawn, or an agreement being reached, like today, can affect the NASDAQ. Let's see. So now the NASDAQ used to be mostly technology, but ever since that dot-com bubble, they tried to even things out a little bit so that if technology did implode, it wouldn't take everyone to the poorhouse. I think we've pretty much talked about this. We expect the petroleum inventory numbers, EIA, API, the Hughes rig count. Do we expect that to affect the NASDAQ? Not really, right? I think we've pretty much covered this. I mean, OPEC reports aren't going to affect the NASDAQ. All right. So, gosh, we're running out of time. Let's see. So, okay, today, when the news of that interim agreement to support Obamacare came out and healthcare rallied, did anybody notice that suddenly the other three indexes caught up with the Dow a little bit? And even the Dow started to come back up? Well, it was kind of an interesting day in terms of market internals. Not much range on the day, but the internals showed their stuff. So let's just take a quick look at that. Okay. Oops, but we're looking at the cumulative delta, which is fine. Okay, yeah, let's do this. So when we're trading the indexes during the regular trading hours, we've got the market internals, which is awesome, right? But we don't have any of that great information when we're trading the Globex and the overnight. So this is called cumulative delta. And frankly, this is one I rely on pretty heavily now whenever I'm trading, day or night. Positive delta, it's not even on here. Positive delta is the number of contracts being bought at the ask, right? The number of aggressive buys. Negative delta is the number of contracts sold at the bid, the number of aggressive sales. Cumulative delta, and that's really the number that matters, at least in terms of this chart, is the sum of the two. So the number of contracts bought at the ask less the number of contracts, well, combine the two, plus, minus, I'm not sure which to, just combine the net value of the positive delta and the net value of the negative delta. That gives you the cumulative delta. And if the cumulative delta is positive, that means more of the market orders are, buy orders, market buy orders, aggressive buyers. If cumulative delta is negative, that means more of the market orders are to sell. That gives you kind of a bearish tinge. And like all of these indicators, it's all about divergence because we're looking for the turning points in the market for our entries and exits. When price and cumulative delta are moving in sync, who cares? There's nothing to see here. It's when they do this. Yay, I have it. It's when they do this. This is when we care about these indicators. This one's going up, and this one is going down. That's divergence. That's when it's time to pay attention because price action might get interesting. And I've said it before, I've said it again. It's not a signal. It's a, hey, you pay attention. Now, never a blind buy or a blind sell. Now, cumulative delta is really help us see the flow of the market orders. But market orders are not the only order type that gets filled. Remember back when we talked about the spread and I said it's all the market orders are the people taking the other side to end that standoff, right? Well, the market orders are the other side, but the market orders are filling the resting orders in the book. So just because cumulative delta is negative and there's lots of market orders to sell, that doesn't mean price will automatically go down because there has to be enough market orders to overcome the resting orders. Now, hopefully that rings a bell for you guys, but if not, please review the first part of class 5 when we talked about the spread and how many contracts we had to buy and sell or sell at market to make price move. Market orders are always the aggressive side, but there has to be enough aggression to overcome those passive resting orders that are in the book. Now, like I said, if cumulative delta and price are moving together, there's nothing to see. But when they diverge, one or the other is going to play catch up, which means something's in the works. In this case, either price is going to move down or the delta is going to come up. So it would be useful at this point to take a quick look at the order at the DOM ladder. So price was going up, delta was going down. That's the divergence we're checking on in this chart. So look, here's the volume profile over here. This is a chart a friend of mine put together for me. We call it the mega dome because it packs mega data all into one chart, and you can't really see it all because half of it's somehow part of it's cut off. Anyway, so the blue area, you guys are familiar with this. This is the value area, developing value area. This is the developing point of control. These are range value area extremes, below value, above value. And here, this is the price path. Now, each of these bars is created by price moving. I think this one's on 5 ticks. So if price moves 5 ticks past, we get a new bar. And this shows you how many were sold at the ask versus, remember we go this way. Can you see this pen? Versus how many are sold at, oh dear, it's getting late for me. Okay, sold at the bid. Let me get a different color. Versus bought at the ask. This is Sierra. And these are, some of these are custom built charts. Some of them aren't. I talked to Jeremy. I know a lot of you have been emailing me about my charts. I'll give you my email again at the end of the class. If you're interested, I can hook you up with the guy who did these and you can have charts that are just like mine. So this is So this is the sold at the bid versus bought at the ask, right? Because the spread goes like this. It's always this bid or this ask. So trade will happen really at 2 prices. I mean, it'll only happen at 1 price, but depending on if you're buying or selling, it could happen at either one of those. Thanks, Laryl. They are. I'm really, really happy with them. So this is, and there's other software that does this. I mean, this is this like price path. We had to call it that because it's kind of a lot like market profile has those footprint charts, but they charge you a monthly fee. So we built this in Sierra. It doesn't cost anything. Once it's yours, it's yours. Anyway, these columns here keep track of recent price action. But this is what happened right now. Like the very last time price touched here, this is what happened. The time before price touched here, it shows you what the trade was like at each price. And then this is cumulative for as long as you've had this chart open. So there would be a lot more information here, but I had to do some work over the weekend and close my chart. So this is just all the information from Monday. All of the contracts bought. I don't know why I get this so confused. All the contracts sold versus all the contracts bought at these price levels since the chart's been open. These green and red dots you see over here are large buys, large sells. These are large buys and sells, but not as large as these. Every once in a while, you will see one that's so fat. Oops, I forgot I'm not on my... Whee! Everybody dizzy now? Every once in a while, you'll see like a really big one, and that's, notable. So what were we doing here? We were looking, we had some delta divergence, negative delta divergence. Price was going up and delta was going down. So we were coming, before I got off on a tangent, we were coming to see if price would go down or if we thought delta would come back up to join in the party with price. So the key to that is to look. Obviously, we've got some selling here. These are contracts sold at the bid, and these are contracts bought at the ask. And you can see there's been some pretty heavy selling. That's why the delta is negative, as opposed to the amount of buying at this level hasn't been very strong compared, right? 826 to 83, 505 to 17. Obviously, the selling's been a lot heavier. But we want to know, is it going to continue to sell? And the best way to evaluate that, I find, is to come over here and look at how many orders are waiting in the wings and where there's been big buys. For example, it kind of looks like really we're approaching support right here. We've got this level, some pretty substantial accumulation of long orders, and here and here. I think if we get below this point, it's going to fall apart, but I don't think it's going down that low, especially looking at some of these buy orders. Like here's one, 1470. Here's another one, 1446. And they're not crazy out of line with the rest of the orders to buy. So, this one might be iffy because these are the, I've probably confused everyone now. This is the add pull. And it shows you when orders get added to the queue and when they get taken away. And hopefully I'll figure out a way to show you how this works actually live. Maybe we'll do a live trading class. That'll help. But, the sellers have been aggressive, but I think this is just a press down to give these positions down here in this area a chance to grow size. So in my opinion, the trades that have happened down here don't support continued downside, particularly with all these orders to eat through in a bull market. I think unless these start getting pulled and suddenly there's negative signs in front of all of these, I think it's going to hold somewhere around this area. And it's not a true short. Anyway, hopefully I didn't lose you guys. I'm sorry. That was a rambling thing. So divergence with internals, price was flat, but cumulative delta on the decline, growing more and more negative. That would be here. So where's the pen? I need to change the color. I'm sorry. I'm going to get us through. We're almost to the end. Okay. So price is flat. Right here, price is flat. See how this shows you the price? We're trading in what? Like maybe a 2-point range at most. But delta, if you look down here, here's cumulative delta is getting, look, more and more negative. See how these red numbers are getting bigger and bigger and bigger? That's a sign that this balance area is probably going to break out to the downside before it breaks out to the upside. Now, I would take a look at the other market internals. The VIX, the VOLT, nothing goes down without the VIX coming up. That's an important thing to remember. Same thing with the VOLT. It's really hard for the market to go down if the VOLT is going up. But if you're seeing divergence across the board in the VOLT, the tick, the ad line, that's a sign that it's probably going to go down before it goes up. Sadly, I don't seem to have this day, but let's take a look at today's action and the internals. And now, la la la. Now today, you could kind of had some good clues right off the bat that the market wasn't going to be going up today. The first one was this at the open. You can see price is moving up, and the AD line is not. And price even made a new high, and the AD line did not. And in fact, the AD line broke that level of support. And as soon as it did that, that was a good sign to look for a short here. And you could have had a very nice trade. When it bottomed here, it was time to buy. And you get 1, 2, 3 of them up. But then again, price came back up to this old high. AD didn't make it that far. So that would have me think, I'm going to keep an eye out. There's probably another short opportunity coming. And that's confirmed by the VOLT, which basically just went down all day. It had a couple of flat spots, but really, it just trended down. And tick spent a lot of the day below zero, more than it has in a long time, right? We're used to seeing it, at least for the past couple weeks, being above zero. And here it just kind of did this. And if I squished this up, which I don't think I can, for most of the day, the tick, it was like there was it was like a slide. Someone built a slide, and on the 2-minute chart, it just never broke above this trend line. It was candle after candle. It just couldn't break above this until later in the day when that news about the Obamacare deal came. Now, these particular ones are set to 5-minute. I like to use both 5 and 2-minute just because 2-minute gives me that precision where I can actually see where and when a turn might be happening. But the 5-minute keeps me from doing something stupid like forgetting it's trending. Like there could have been in the 2-minute candles in this something, a couple of red candles here and there. And I could have said, okay, this is it. It's going to go back down. But if I had turned my head and noticed that the 5-minute chart was clearly in an unbroken trend going upward, I wouldn't have gotten short. So that stops me from doing stupid things, at least most of the time. And also the other huge hint today, has anybody been watching the VIX this week? Where's it been? I mean, has it been over 10 much even? It's been in like the 9.5, 9.3. The VIX has been really low for a while. But today, not only did we get above 10 way down here, we stayed above 10 most of the day and pretty much kept going higher. Now, we didn't get into any kind of, major volatility range, but it's higher than it's been in a while. Okay, so what did that look like on the charts I use on Sierra? Well, we can see the decline here on the 15-minute, but by the time we notice that, it's a little late in the day. But what I would like to point out is that we broke into this value area and we tested, I don't know what we tested. Oh, this is the overnight. Ignore this. Sorry, guys, wrong chart. Let's look at the cumulative delta here. You can see this is where it was coming down. It kept coming down. See how it's moving with price? But then there's a point up here where suddenly you can see it's starting to change. I don't know why I have this chart here. This isn't good. But here, look. There's the VOLT. It's different. They have a different name for it on Sierra. They call it, this one's is specific to the S&P. It never broke this trend all day long. Not until like the end of the day, it broke this little miniature one and it went up a little. Not going to be an up day. And for the record, I do believe that the VIX was, I'm not the VIX, the skew this morning was up above 143 or something. Anyway, did this change? It did. Okay, this is the regular hours. This is what matters. And I just want to quickly take a look at how this blue area here, this blue highlight is yesterday's value area. And then these blue lines are today's developing, today's POC. Here's yesterday's volume profile. And look at how nearly perfectly this traded according to what we learned earlier, right? It came up, came down to the POC. It broke it both ways. Okay, that no longer counts. It came down to the weekly value area low. And I did actually go to the weekly on this. Came back up, tested the weekly value area high. Then came back down, sort of fiddled around a little, back to the value area low, right? And where's the most trade? Yesterday's POC. See that? Most of the trade within this range and within most of yesterday's range. And then the news comes out, we break out back into the value area, back up. And I think this is, if it's not to the measured move, it's pretty darn close. Anyway, I just wanted to point that out and bore you guys some more. So just a couple of quick things to think about before we finish for tonight. When the market is in value and range bound, what's the nearest KRA? Is there enough between here and there that I can get my risk to reward? Where do I think, what KRA do I think it's going to, the trend would stop at? Is there a price that people are going to close? Where are their stops? Where are their targets? Where might new money enter the market, particularly bigger money? And always know if you're in a mature balance area, you do not want to be fading when you're in a mature balance area. A mature balance area is about to turn into what? The trend. So you ask yourself, who's in control for how long? Where's the nearest KRA? And all those same questions. To be a profitable futures day trader, you need to be able to identify the most likely prices, market participants will take action, and what kind of action it's going to be. Those are the price points you want to focus on for creating your entries, placing your stops, and marking your targets. So do I have anything else to say about that? No. You remember this slide? We'll look at it again next week. We're really out of time. I'm sorry, we went like a half hour over, but it's big deal stuff. The most important thing, know yourself. If you have a tendency to move your stops, your targets, or you see that big green candle form and you jump right in, don't do it. If you're that kind of trader, the best thing you can do is to place a resting OCO order at your KRA that you're interested and just walk away from the computer and let the market do its thing. Go do something else for a while. It's amazing how many trades actually work, even if you're not sitting there staring at them. So be patient with yourself as you learn and grow. Be patient with the market. Always wait for the right entry. Proper entry ensures stop worth honoring. It's better to miss a trade than try to get in at a bad price. I'm going to get off the soapbox now. I don't think I was hoping we could do a little overnight trading, but obviously we're out of time. Thanks, Don. I love you guys too. I got to tell you the feedback that I've been hearing from all of you. Oh, let me put my email in the chat just in case anyone's interested or has questions. You could email me, or if you're interested in getting charts that are just like mine, I don't think it's very expensive. And if there's enough people interested, maybe I can work out some kind of bulk deal for everybody. If you want the charts that are exactly like mine and work exactly like mine, just send me an email. It would just be a one-time authorization kind of thing. And compared to the amount of time it saves you setting stuff up and learning the platform, I thought it was totally worth it. But, you guys might feel differently. You might not even be interested. If you are, send me an email and I'll give you the contact info for the guy who put the stuff together. It's all him. I'll just be like the person that connects you guys up. Kristen, not Kristen. I'm sorry. What is a fair suggested timeline to learn these basics and all the lingo? It depends on how gung-ho you are, Jen. If you say, oh my God, this is the bomb, I'm going to get into this, it's stuff, it comes to you fairly quickly. The more you look at it, the more you watch the charts, the more you find people that are, oh, you didn't see it? Oh, somehow it went private. I'm sorry. Let me change that. The more you look at it, the more it comes to you. I don't know. It took me maybe a month at the most to really kind of integrate everything. Hopefully you can see the email address now. But be patient with yourself. It's like it takes a while for it all to become one with your process. Yes. Thank you, sir. Oh, not a sprint. It's a marathon. The most important thing is preserve your capital, live to trade another day. Catherine Zwick, are you still here? I thought you had a question about something about the holes, filling the holes. Maybe you're gone. All right. Well, I know it's been a long one. I'm sorry, you guys. I appreciate all your feedback and I love hearing from you and helping you. Oh, Catherine, you want to just Skype? All right, I'm going to wrap this up and I'm going to go Skype with Catherine. You're welcome, everybody. Have a great night. And again, final class Thursday, same bat time, same bat station. Good night, everybody.